Hey, Token Metrics family, welcome to another episode of Moon Mission with your host, Ian Belina. And in today's show, we're going to do a deep dive into how to master the cryptocurrency cycle, but also all kinds of investment cycles, and also how to be a value investor. We're going to go through and basically give you the Cliff Notes version of two books that make up the foundation of my investment philosophy. Howard Marks is a billionaire hedge fund investor on Wall Street who's made his name, he's built his name and his brand being a fundamental analysis, value-driven investor. He's modeled himself after Warren Buffett, and lots of people in the space call him the new Warren Buffett. And to me, honestly, he's even much better than Warren Buffett himself. So let's dive into two of his books. The first book is called The Most Important Thing: Uncommon Sense for the Thoughtful Investor. Now, if you have not read this book, pause the video right now, go on Amazon and order the book right now. Like if I had to pick one single book, and I read probably 2 books a month for the last 20 years or so. And if I could pick one single book that is the best book out there when it comes to investing, this is the book. This is no hype, no fluff. This literally is the book. I mean, even Amazon, it has great reviews on here. 4.6. It should actually be 5. That's how good it is. But why is this book so good? Because this book, in very common sense, simple terms, goes through and explains why it pays to be a value investor, why it pays to buy projects that are undervalued, and how to do it. Right? So without having to go through all the book, we'll go through. So when you get the audiobook, it comes with charts in the book. So we're going to go through and dive through these charts, and hopefully by the time we're done, you'll have a better understanding of what it means to be a value investor. So basically, you have two different approaches, right? You have investors who try to follow conventional behavior. They're basically doing what everybody else does. People, for example, people that buy Bitcoin, right? That's why over here at Token Metrics, we made our money with Bitcoin and we moved on, right? So basically, you have conventional behavior and you have unconventional behavior, right? So if we get conventional behavior with a favorable outcome, what does that mean? That means it's likely going to do very well. You get average to good results, right? Average good results. It's nice, but it's average. Then if we get conventional behavior with unfavorable outcomes, you get average bad results. It's still average. But if you want to have above average results, you by definition have to have unconventional behavior. You have to do the opposite of what everybody's doing. You have to zig while they zag. And if you have unconventional behavior with unfavorable outcomes, then you have below average results. But in general, if you want to do well, you cannot follow the herd. You have to be your own individual, your own investor. You have to go against the grain. All right, so let's continue. Okay, so I like this chart here. This is a simple graph. This is not rocket science, right? A simple graph that shows you basically the return and the risk, right? It's basically plotting return versus risk. And as you see here, as the level of risk you take on as an investor rises, you should expect your level of return to rise as well, right? High risk, high reward. That's an old adage. All of us know that if you've been investing for a while. But however, if you notice this, right, this is the deviation of the returns, because it's not necessarily gonna always be on that point on this line. It could deviate, right? So for example, if you take on this low level of risk, you should expect the returns to be not just at the start, but somewhere within this deviation. Now, if we go all the way to the end of this line, for those people who are trying to swing for the home runs, right? The average return will be somewhere around here. However, the deviation, the range will be, you could hit a home run and have returns that go all the way up over here, or you can strike out and go to zero. But, right, very few people understand that. When you're investing in risky assets like cryptocurrencies, yes, you can go to 100x, 1000x, but you should also understand that you can go to zero. For those of us who learned this lesson in the last market cycle, we know that now, right? But very few people see that. They see the average here and don't realize that this is a range. So being a value investor, and this book, in very simple, plain terms, tries to illustrate what that means. So for example here, looking at different markets, right? So we have at the lowest end of the risk to return line or curve is money markets. You can basically expect here about 4%. This might have dropped after the pandemic, but and inflation. But in general, the higher up you go from 5-year Treasury, 10-year Treasury, high-grade bonds, S&P stocks, high-yield bonds, small stocks, real estate, buyouts, and venture capital. Venture capital and private equity are basically the riskiest in terms of the eyes of legacy markets. But now we have a whole new market called cryptocurrencies, which are even more riskier, right? So, however, we take on that risk willingly because we can get incredible returns. Okay, so now let's move on to this other chart here. So this chart, the same thing. We have risk versus return, right? This is basically the benchmark. This could be the S&P 500, could be any index. In crypto, the benchmark is Bitcoin. So imagine this is Bitcoin. Imagine Bitcoin has this level of risk, and you can anticipate this level of returns. Now, if we take this and let's say your portfolio or my portfolio has this level of return versus the benchmark, this difference is the value you have added as an investor. That's the value add. You have outperformed the market. This is what all of us should strive to do. In crypto, we want to outperform Bitcoin, and we also want to outperform the whole crypto market as a whole. Now let's take that same chart and add an extra dot on this, right? So we take this dot, the benchmark, and we move this all the way to the left. So in this case, this portfolio has achieved the same level of returns as the benchmark by taking on less risk. This is crucial. So even though it's the same return, the fact that it took on less risk means that this portfolio has outperformed the benchmark because it's not investing in riskier plays versus a benchmark, right? So this is a value add as well. So we have two value adds. One, getting returns that outperform the benchmark, as you see here, and also getting returns that are on par with the benchmark, but have less risk, less volatility. Okay, so then there's a section in the book where they go through a simple exercise, and basically what they're saying is look at the market and think of this as a survey, as a questionnaire, and ask yourself this, right? Where does the market fall today? And wherever it falls, just circle that. And if you find that most of your check marks are on the left-hand column, Howard Marks says, hold on to your wallet. It's a frothy market. Now's not the time to buy. Because if you do, you're basically buying the top. And let's go through that, right? So if the economy is vibrant, if it's positive, if the outlook is positive, if lenders are eager, capital markets are loose, capital is plentiful, terms are easy, interest rates are low, spreads are narrow, investors are optimistic, sanguine, eager to buy, essentially FOMO, asset owners are happy to hold, they hodl because they're going to the moon and beyond, sellers are few, markets are crowded, funds are hard to gain entry in, meaning hedge funds or investment funds. New ones are opening up daily. General partners hold all the cards. Recent performance is strong. Asset prices are high. Prospective returns are low. Risk is high. Popular qualities, aggressiveness, and broad reach, right? So right now, honestly, we're in a bull market. So this in crypto would fall heavily in this camp. And actually being a value investor, Howard Marks would say, now's the time you take profits. Now's not the time to be buying. But if you're new to crypto, don't worry. You can still find undervalued assets in this market. However, the best time to buy is always bear markets, right? And essentially, because when you're buying on the left-hand column, you're paying a premium because the market is just so hot. But if in a bear market, the economy is sluggish, the outlook is negative, lenders are reticent, capital markets are tight, capital is scarce, restrictive terms are restrictive, interest rates are high, spreads are wide, investors are pessimistic, distressed, uninterested in buying, asset owners are rushing for the exits, Sellers are many. Markets are starved for attention. Funds open to anyone. Only the best can raise money. General partners, limited partners have bargaining power. Recent performance is weak. Asset prices are low. Prospective returns are high. Risk is low. Popular qualities, caution and discipline and selectivity. So if you're looking to buy and get the best entry and get things at a discount, the right-hand column is where you buy. That's why this is where buy low, sell high comes from. But very people actually understand this, and this book helps explain this in plain English, right? It takes no rocket scientist to know that it's better off buying on the right-hand side. However, the psyche of people and humans makes people more predisposed to want to buy when all this is happening, even though that's the wrong move fundamentally. Right. So a good way to sum up what they call Talib's view, right, is basically this. Okay, so the first column are things that can easily be mistaken for things in the second column. So luck can be mistaken for skill. Randomness can be mistaken for determinism. Probability can be mistaken for certainty. And now let's continue, right? Then down below, belief conjecture will be mistaken for knowledge and certitude and so on, right? In general, there's lots of fluff and noise in the markets, and you want to make sure you don't really mistake things. Okay, so now they go on to this other section, right? It's basically looking at the returns of the benchmark versus the portfolio return, right? So in this case, we have an investor, an asset manager, who basically achieves the same exact return as the asset as the benchmark, right? So basically, this manager has zero skill. He's just giving you the same returns as the benchmark and charging a fee, right? If it's a hedge fund, they're charging 2% management fee, 20% on the profits, right? But he's doing nothing. You're better off just putting your money in a benchmark or index fund or Bitcoin, getting the same level of returns with no fees, right? But then let's take this other example. So in this example, the benchmark, period 1, benchmark is 10, portfolio return is 5, then we have 6 and 3, 0, 0, minus 10, minus 5, 20, and 10, right? This one also has no skill. Why? Because he's moving halfway the market is moving, right? When the market is going up, the returns are going half as much up. When the market is going down, the returns are going, the losses are half, right? So he's not really adding much value, right? He's still basically just giving you the same level as the benchmark. Now, if we move on here, right, we have this other example. This one moves twice as much, right? But however, it's the same thing, right? Moving twice as much up, right? Because when the market goes up, their portfolio goes up twice as much. But when the market goes down, the portfolio goes down twice as much, right? So at the end of the day, it's just canceling out. So looking at this one, right, this example here, this portfolio manager has a little outperformance versus the market. Because when it goes up slightly by 1 over here and here. And when it goes down less 1 as well. But this one has a lot of outsized returns versus the benchmark, right? It's going up by 2 versus the benchmark over here by 4, over here plus 3, then over here, market goes down minus 10. His returns are, or their returns are 2 and 30. So in this example here, this asset manager is doing very, very well. This is a strong portfolio. We want to achieve the same level of results in crypto. This is why we don't chase meme coins, because the risk you're taking on is not worth it. And then same thing here, right? Benchmark is 10, the return is 25, 6, 20, 0, minus 5, minus 10, minus 20, 20, 25. So this has great returns. However, there's more volatility. Okay, so now let's really break down the aggressive investor and the defensive investor, right? So the aggressive investor without skill gains a lot when the market goes up and loses a lot when the market goes down. But the aggressive investor with skill gains a lot when the market goes up, but doesn't lose to the same degree when the market goes down. That's what makes a great home run hitter. That's what makes a great aggressive investor. Now, for a defensive investor without skill, doesn't lose much when the market goes down, but doesn't gain much when the market goes up. Then the defensive investor with skill doesn't lose much when the market goes down, but captures a fair bit of the gain when the market goes up. Now, these two concepts are concepts you should understand as a value investor: defensive investor and aggressive investor. Okay, so hopefully that was helpful. That was the book called The Most Important Thing. Great book, the book on fundamental investing and being a value investor. Now let's go to the other book. This is also a pretty good book. Not as good as the other one, but still pretty good, still worth reading, especially if you want to master the market cycle. That's why it's called Mastering the Market Cycle, Getting the Odds on Your Side. So let's go through this chart again. And we're going to skip straight to this chart. This is basically a market cycle. And looking at this, one thing you'll notice is even when the market is going up, there are short-term cycles inside the market cycle. So this is a bull trend, right? So basically this from here to here is basically a bull market, but you still have lows, but you're making higher lows, right? The lows are going higher and higher, but you still have crashes. So this crashes, one crash here, 2, 3, right? And it basically says right here. The main thing I want to discuss here is my realization that there are cycles in the long-term trend, not just short-term cycles around it. And we've been living through the positive phase of a big one. And this is when he made the book. But if you take this and you apply this to crypto, this happens every week, every month, every quarter, every year in crypto. And guess what? Last week was possibly one of those large crashes, right? Those large dips where the market corrected 50%. So when you see a large dip or crash, it's not necessarily the end of the world. If anything, it's actually a good buying opportunity because you want to buy the dips here. Because how do you buy and make money in a bull market? You buy the crashes. You buy red candles. Like when it dips, let's say you missed it here, it dips here, you buy, it goes up, you buy here. You don't want to be buying tops. And it's hard to time the market, but we do have the visual trends indicator that help you with that. So imagine this is the dot on this market cycle, right? We're in a bull market trending upwards, and the dot is here, right? Then we have this other chart that basically is a distribution of the outlook for returns. So looking at this dot here, we can see that if you buy here, right, the probability is the outlook for returns are positive, right? More likely than not, you will make money. Why? Because you're not buying from the top here. You're buying when the price is much lower. However, you still have a chance of having negative returns. However, right, probability is on your side. This is one element of the market cycle, right? Basically buying here on this trend line. Now, however, let's say you buy the top here. Your chance of making great returns decreases. It basically flips. Now, it's not impossible, right? There's always that probability. However, you're basically buying the top, right? So the outlook for returns, more probable than not, is negative. So this is why we almost always want to be buying when the market is crashing, right? Not when the market is going up. And now we go to the best time to buy. Buying the dip right here, right? So this dot here, the likelihood for having great returns increases a lot. This is the best it's basically going to get. Now, it's not impossible. You can still lose money. Nothing is guaranteed in investing. However, compared to everything else, buying when the market has retraced a lot, like what happened recently when the market crashed 50%, ask yourself this: where does that fall on the line? It's definitely not here. A 50% drop probably falls somewhere around here. So it's a great buying opportunity. This is basically looking at the returns and the relative probability of occurring. So these are basically the solid line are the market returns, and the dotted line are the returns for the aggressive investor. Recall, back over here, we talked about the aggressive investor. Right? So now we're looking at how this applies towards the market cycle. The aggressive investor has outperformance. They will do better than the market during this period here, right? because they're being aggressive at the right time. All right, so let's go through this again. So this is relative probability of occurring versus return. And as we see here, the aggressive investor gets outperformance versus the market from here to here because they're being aggressive at the right time. Now, if we take that and we flip it with the defensive investor, this is the defensive investor. You basically have somebody who's being more cautious, right? And these are their returns versus the market. The market is a solid line. The dotted line are their returns. Now, we notice here with the defensive investor, they outperform the market by being defensive at the right time, basically during bear markets. During bear markets, they'll get better returns because their max drawdown will be lower because they're defensive, while an aggressive investor will have better returns because during a bull run because they're being more aggressive at the right time. So essentially, in a bull market, you want to be an aggressive investor. However, a value investor, meaning that you're getting compensated for the risk, and vice versa during a bear market. Now, let's see when they underperform. A defensive investor will underperform when they're being defensive at the wrong time. If they're being defensive, for example, here, maybe during a bull market, when the market outperforms them, that's not good. Then, same thing with the aggressive investor, but the opposite of that. Let's move on to this. So here we have the returns of the market, and this dotted line are the returns of a negative skilled investor. Polite way of saying somebody who's basically not doing too well, right? So as you see here, you're better off just holding an index fund, Bitcoin, or the market, or whatever benchmark you have. This person is not offering any value. Yes, they may have positive returns, but they're not offering any value at all versus the market. Now we take this other example, the skilled investor, right? The skilled investor versus the market will outperform the market here and have great returns. This is where they add their skill. They may underperform the market during crashes. However, they still outperform the market long-term when the market goes up. Now, this is the same chart, but different. This is the skilled defensive investor. They basically, this is the value they're adding, right? They do better when the market crashes. They don't lose as much money. And then when the market is going up, they still, because they're defensive, won't do as well as the aggressive investor, however, and the market. However, they're close to them, right? They're right behind their tail. And this is where they add their value. Now, this is an example of a highly skilled investor, where you, during a crash, you keep your money, your max drawdown is low versus the market. And during a bull run, you also outperform the market. So you're basically beating the market when it crashes and when it goes up. This is very rare, but this is a goal. This is why we built Token Metrics, to help you, our customers, beat the market when it's going up and also beat it when it's going down. Okay, and this chart right here basically sums up value investing, right? This is basically because now we have the market cycle once again, and now we have this trend line, and this trend line is basically the intrinsic value, right? So the market will go whichever way the wind blows. It will go up, it will go down, up and down, even in a bull trend. However, you have a trend line that basically tells you this is the actual intrinsic value, the fundamental value of this asset. And the times you want to buy this asset is when it's cheap. You have fair and cheap and rich. You definitely don't want to buy it when it's rich. This is called buying the top. Value investors do not do this. They buy dips. They buy when it's cheap, when it's undervalued. That's why buying in a bear market is typically ideal. But you can still do well buying in a bull market. Just make sure you're buying corrections, like what happened recently. Because if we're still in the bull market right now, best case an example, let's go to Polygon. Because Polygon, one of the 100x projects we covered, back in a bear market, which is the best time to buy it because it was cheap, it wasn't even trading yet. if we pull this up here, so if you notice here, it crashed. Let's do 7-day chart. Right, so it went from $2.57 during the correction, went all the way down to 92 cents. Actually, sorry, 81 cents. So from the 23rd on Sunday, the top from Tuesday to Sunday, less than a week, it dropped from 2.57 to 81 cents. And guess what? People thought it was the end of the world. They become pessimistic. And coming back here, when things became sluggish, things pivoted very quickly due to news from China, from Bitcoin banning Bitcoin mining, regulation, FUD, what have you, right? Everything went from vibrant, positive, and all this kumbaya to this. It flipped on a dime. The music stopped. And that was the best time to buy during a bull market in a correction, right? So going back to, right, because you have this, right? The market can still go up in a bull market, but you still have crashes. You basically are getting higher lows, and you want to buy the lows, right? So imagine this is Polygon, 257, drops all the way down to 81 cents in less than 7 days. Now it's cheap. Now you buy, right? And guess what? Textbook is now up 60% today. So if you're looking for an entry and you were patient, you were waiting for that pullback, that correction, that was a very good entry. Now, obviously, nothing is guaranteed. You can still lose money. We could enter a bear market, or we could have a crash. It could be a dead cat bounce. However, practicing using this system, this method, this strategy will help you outperform and be better than average. And in general, that's the strategy, because value plays, investments that are cheap. For example, if we go to Helium, that was one of our value investment plays. Let's see how much that's up today. That's up 22% today. Same thing with that. It crashed as well. Because if we go to the last 7 days, so the high was 17.14. It dropped all the way down to 9.20. And for those watching live stream, you know that Forrest bought exactly here, right? Forrest is also a value investor, right? He basically bought when Helium was cheap, and he was watching Helium for a while. Me, Bill, our entire team have been talking about it for a while, but he was a patient investor. He said, you know what? I like this project. I'll put it on my watch list, and I'll wait to buy it when it dips. I will to buy it when it goes to the trend line. And Forrest says this is his trend line, right? But same exact model. So hopefully that has been helpful. All right, with that being said, this concludes Moon Mission, and I hope you like the new flag. We got the NASA flag, because we're going to the moon and beyond. And as we like to say, the moon is not the limit. To the moon and beyond. I'll see you next week. Thank you.